In today's video, I want to go over a little bit more in depth of what I'm looking at in the metals sector and why I think it's probably a good time to just take your profits and be patient for a little bit. So this is the silver chart. As far as I can tell, and I'll show you the gold chart here in just a minute, this looks like a move down into a daily cycle low right here. And it looks like the same thing in the gold chart and the mining stocks chart. So if an asset is in the advancing phase of a larger intermediate cycle, then you don't want to see a daily cycle drop below a previous daily cycle low. So basically, you don't want to see a lower low. And that's what we have here in silver. And granted, this is the metals are one of the most highly manipulated markets on the planet, but still, the rule still holds, even though this was obviously a manufactured move. It still has the possibility of producing the declining phase of the larger intermediate cycle. So if this is our daily cycle low, then the attack on Thursday pushed price below that low, created a lower low, and then we got some follow through on Friday. Somewhere here we'll get a little bounce, but I think you probably want to view any bounce with a big grain of salt. Once this is broken, then the chart is broken. So let me show you what I think might happen. All right, so and I'm not saying that this is going to happen early next week, but I'm just showing this as a possibility and why people get stuck and can't sell their position. So if you are anticipating that the metals were going to go higher, and I think a lot of us were, when the market tells you that you're wrong, you have to, switch gears and go 180 degrees in the opposite direction. So when we got this dip down here, I suggested people go ahead and take at least half profits on their metals position. And then when I saw this attack on Thursday, I told people to take lock up the rest of their gains on their metals in the premium newsletter anyway. So this is a broken chart, not long term, but just short term, and it is suggesting that we have begun the declining phase of the intermediate cycle because we've made a lower low. And so this is what keeps people holding on is the dip buyers that have been rewarded all the way up, and they were even rewarded right here at this daily cycle low. If you bought this dip, you were rewarded because it came up and made a higher high. But then you kind of got caught, and with that attack on Thursday, now it made a lower low. But you've still got the mindset that you should buy dips, but really you shouldn't. You should probably sell rallies at this point until the intermediate decline is finished, and they usually last anywhere from 4 to 6 weeks. So if we get a bounce, or whenever we do, there will be bounces on the way down. If we get a bounce here, I think you should take that with a big grain of salt. And if you are still holding on to long positions, you should probably use any bounces to get out of those long positions and get on the sidelines, because the bounces are probably, at this point, probably not going to make a higher high. They'll probably come up short, and then we'll have another leg down, and this can happen several times on the way down into a larger degree intermediate cycle low. So we've got a broken chart on silver, and this suggests that silver is in the declining phase of the intermediate cycle. Now, if we go over to the mining ETF, GDX, it's not broken yet, but this is not the kind of look I want to see, especially during what would maybe be considered a second or third daily cycle. You don't want to see a very short temporary rally and then a quick retest of this daily cycle low pivot. If this is going to be a successful daily cycle and one that is still in the advancing phase of the larger intermediate cycle, then you just want to see small little pullbacks, like maybe to here. And actually, until Thursday, there was nothing wrong with this chart. Up to, well, Wednesday, I guess it would be. At Wednesday, this just looked like a bull flag that was consolidating and preparing to break out to new highs. It was the attack on Thursday that broke the chart. This early in a new daily cycle, you don't want to see price coming back down here and getting anywhere near this pivot. And if sometime next week, if price breaks below this pivot, then you've got that same broken chart in the mining ETFs. You've got a lower low, which indicates that we're now in the declining phase of the intermediate cycle. All right, and now here's the final chart, gold, which is in better shape. You know, it's not a broken chart like silver, and it's not, you know, hanging on the edge like the mining chart, but kind of the same thing. We've got what looks like a double top here. Obviously, I pointed this out. The banking cartels has been hitting gold, trying to make sure they prevent a weekly close above 2050, and so far they've accomplished that. And the pivot to watch is right here. This is our daily cycle low. It's at about let's call it 1980. If gold drops below 1980 next week or the week after, then that is your final confirmation that that this daily cycle is left translating and starting the move down into the intermediate cycle low. We would then be in the declining phase of the intermediate cycle. So I've gone over this in detail with subscribers, but I am kind of now of the opinion that this is one really long intermediate cycle. And I think this was, I'm tending to count this as a daily cycle low, and just one that was, we had a bunch of manipulation from the banking cartel that probably stretched this out a little longer and a little deeper than it would have gone normally. But still, I would say this is probably a daily cycle low. So you'd have one daily cycle, two daily cycles, and now we would be in the third daily cycle, and this third daily cycle is threatening to left translate and start that pattern of lower lows and lower highs. So watch the gold market. Any move, and it doesn't even have to be a close, just any move below 1980 is your signal that gold is now in the declining phase of its intermediate cycle. You want to be out of trading positions. Long-term positions are fine. All bull markets have intermediate degree corrections, and it doesn't change the long-term direction. But they're, these intermediate declines, as I said, they usually run 4 to 6 weeks. And for traders with short attention spans or too much leverage, these intermediate cycle declines are the ones that tend to knock these people out right at the bottom. They ignore the pattern. Like right now, I suspect there are a lot of gold bugs that are ignoring that lower low in silver and trying to make excuses for why it's going to recover. And then if the mining stocks also make a lower low next week, that would be even more confirmation. And I suspect people will, then try and make some excuse for why that's going to recover, and they will ignore the warning signs that metals are now in the declining phase of the intermediate cycle. So in order to correct this pattern, first off, gold would need to make a higher high. Gold would have to come up here and get above 2085. If it does that, then at that point I think you could go ahead and put your positions back on. But right now there's a warning sign in silver. There's a potential warning sign in the miners. They're not really doing what they should be doing. And gold is starting to get a little too close to this pivot for my comfort this early in a daily cycle. So, there's big gains here at this point. You don't need to keep pressing your luck, playing musical chairs here. At some point, there is going to be a decline into an intermediate cycle low, and you really don't want to get caught in that with your shorter term positions. Again, long-term positions, things that you're holding for the next 2, 3, 4 years, doesn't really matter. There's going to be lots of intermediate declines along the way, and none of them are going to stop the long-term trend. So like your physical holdings of gold and silver, you would be ridiculous to sell your physical in order to just avoid a 4 to 6 week correction, because that's all they last, 4 to 6 weeks, and then the larger intermediate or the larger trend resumes, and then you come up and you make higher highs again. So watch the gold market closely next week. Also, I would watch the mining stocks very closely. If they break this pivot, this daily cycle low, especially gold, but also the miners, that's your clue. Quit being in denial. Take your profits, get on the sidelines, and then be patient and wait. And I will, as usual, I will be trying to call the bottom when I think we are getting close to it for subscribers, and get us positioned early in a move like we did down here and also here, instead of buying at the top when your emotions tell you, that it's safe to get in, and you recency bias is screaming that you're afraid you're going to miss out, and you got to catch, the move is just getting started, and you want to make sure you don't miss any more, and all you end up doing is getting caught in the declining phase of the intermediate cycle. So one big warning sign in silver, a potential warning sign in the mining stocks, and possibly also in gold next week if we close below 1920. And I would even say any close below 2000 is a big warning sign in gold.